Good afternoon, everyone. I'm Steve Catcher, the Senior Director at VENTURE.co, and I'd like to welcome everyone to our webinar today entitled From Bricks and Mortar to Mailbox Money, Mineral Royalties and 1031 Replacements. 1031 exchanges have become increasingly popular in the past few years as everyone, from aging baby boomers owning apartment buildings to commercial real estate investors feeling long in the cycle. They're moving to lock in profits and from actively managed commercial properties and pivot to institutionally managed, passively managed investments. A common exit strategy is the Delaware Statutory Trust, commonly known as a DST. Less well known is the use of mineral rights and royalties as replacement property in a 1031 exchange. No doubt, every financial planner and asset allocator acknowledges the role of diversification across asset classes and strategies to minimize investor risk. Today, more and more financial advisors are considering mineral rights and royalties as an important part of their replacement property strategy. Mineral rights and royalties offerings may introduce different types of risk and reward to an investment portfolio, aside from traditional commercial real estate. They may also provide tax-advantaged monthly cash distributions to investors, and when properly structured, add an investment growth component to the replacement portfolio. Today's webinar presenter is Greg Lehrmann, Esquire, a seasoned attorney from Austin, Texas, and for 27 years, a qualified intermediary with Asset Preservation Incorporated. We are honored and grateful to have Greg with us today to deliver this presentation on behalf of his firm and Montego Minerals. We thank you for your attendance today, and without further delay, Greg, the floor is yours.
All right, thanks, Steve. Here we go. I am going to cover, of course, I'm going to hit on mineral royalties in 1031s, but in the process, I'm going to hit on more than that. So it's going to be somewhere between just focusing on how royalties fit in with 1031s and an A to Z presentation on 1031. So I've spoken on this for, like you said, 27 years, and this is all I do. So I'm going to get right into it. I won't go over the capital gain taxation. Each person here knows what their capital gains taxes are. The federal tax can be as high as 23.8%. And then some people on this program may have some state tax on top of that. But for 99 years, the tax code has allowed deferral of the gain on sales of real property. And real property is very broadly defined, as we'll talk about in a minute. So, way back in 1921, farmers went to Congress and said, hey, how are we going to trade up from one farm to the next if you're going to tax us? Because if we go from dirt to dirt, we can't pay taxes with dirt. That's how simple this concept is and how powerful it is, how much sense it makes, and how much the economy depends on it. And so they put it in the code way back 99 years ago. It said no gain shall be recognized, which means taxed. Of course, the recognized means taxed on the exchange of real property held for productive use in trade or business or for investment, if such real property is exchanged solely for real property of like kind, blah, blah, blah. So what this says is, if you're doing what they call an exchange of what they call like kind property, you're not taxed on the current sale. The reason I say they call it an exchange and they call it like kind is because it's neither. It's not an exchange or it's like kind. It's a lot better than that. In fact, this whole area of the law boils down to three words. What is like kind? What is exchange? And what is qualified intermediary? That's all anybody has to know. Like kind and exchange have a much better interpretation here than they do anywhere else that I'm aware of. And so when you learn what those two words means, it opens up a lot of opportunity. Now, qualified intermediary is a lot worse than it sounds. And so you have to learn what that means in order to protect what you are gaining by knowing those first two words. There's all kinds of reasons why people do this. Usually it's better to defer tax than to pay now, not always. especially right now. It wouldn't be good. It wouldn't make sense to defer taxes for 1 year or 2 years when we all would probably bet on taxes for a lot of people, if not all, everybody on this call, to go up soon. So you don't defer if you're just going to defer for 1 or 2 years. But most of our clients defer forever. They never pay the tax. So they don't care what the tax rate is. You can defer forever. And even if you don't defer forever, you only pay tax when you decide to get out of the real property, which again includes minerals. Um, and even then, it's without interest. And maybe you're retired then, maybe your tax rate is lower because you're retired. But in any sense, if tax deferral is something that benefits you, that's what 1031s do. It's one of the many ways to defer tax. And a lot of people do it forever. They swap till they drop. And by not paying taxes, you buy more real estate, which pays you more income. So you still benefit, even though you've got to keep your money in those assets. And then when you die, of course, the assets that are still in your estate, the basis steps up and it does go away forever based on current law. You can use it to leverage. So I know somebody that's got a little $300,000 rental property, but their taxes on just that residential rental would be 40 grand, and they're going to sell it and put down with their equity. They're going to put down 25% into more property. So 40 grand that they defer at a 25% down payment adds 160 grand to what they can buy just on one little residential sale. You can use it to diversify, which directly plays into today's topic. You can diversify from residential rentals to apartments, from residential to commercial brick and mortar, from property in one state to property in another, from property in the city to property in the country, from a strip center to a farm. And as we're covering today, the most extreme and exciting to a lot of people form of diversification is actually getting out of brick and mortar, at least to some of your assets or all, and putting into minerals. Consolidation, you can use this to sell a bunch of smaller properties and buy one bigger one, or cash flow. If you have raw land that you bought several years ago, it's gone way up in value. That's great on paper. It's not paying your bills. The 1031 allows you to sell property that pays no cash flow and put it into property that pays cash flow. Management relief also ties directly into today's topic. You can sell property that takes a lot of management and go into property that requires zero management. So basically, there's two groups of people that do 1031s. Younger people, when they're building their wealth, 1031 allows them to buy a lot more real estate because they're not paying taxes. And so they use those tax dollars to buy a lot more real estate. Older people, after they've done that, a lot of times they want to quit doing that, but they don't want to give Uncle Sam any of their hard-earned gains. So they sell high maintenance real estate, whether it's residential rentals, apartments, whatever. And they want to quit doing that, but they don't want to pay taxes. Well, Section 1031 allows them to do that. They've got three options. They can buy a triple net lease property like a Walgreens. They can buy a fractional interest, as Steve mentioned, Delaware statutory trust, a fractional interest in brick and mortar. And then they can buy oil and gas, which is the biggest surprise to most people. And I'm going to go into that more in depth. And then estate planning, you can use it, like I said, you could swap till you drop, and then your heirs get a step up in basis. Even on top of that, I started to say even better, but it's just another huge benefit. I've got a farmer right now that I just helped. He's 86 years old. He farmed his whole life on dirt that didn't cost him much money 50 years ago. He's 86. He doesn't make much money off of farming. That's what he's done his whole life. He needs to quit farming. He could use more cash and less work. On top of that, he's got 5 adult kids, and he doesn't want to leave a farm to 5 adult kids. He said they don't agree, and they have different levels of responsibility. Of course, that's typical. because of Section 1031 and because of the passive investments that qualify for 1031 treatment, he's selling that $5 million ranch. He's putting $2.5 million into brick and mortar DSTs and $2.5 million into mineral royalties. He doesn't have to work anymore. His monthly cash flow is going to go way, way up. Even if it's 5% on 5 million, that's huge. And generally minerals pay more than that. That's outside my area. I'm not a financial advisor. I just know he's doing real well doing this, not having to work. He can have this, enjoy this income the rest of his life. He didn't give Uncle Sam any of his hard-earned gains. And really what's so great is in his will, he's going to leave 20% of the DSTs and 20% of the minerals to each of his 5 heirs. They do not have to get along. They do not have to decide when to sell or whether to do 1031s. Of course, they won't have to anyway, because they'll get a step up in basis, but they don't have to agree. So that's the beauty of the DSTs and the oil and gas. So this is like-kind property. This is why I said like-kind doesn't mean like-kind. I've heard people say like-kind means if you like that kind, buy it. All you have to ask is, am I selling an interest in real property or minerals anywhere in the US that I was holding for use in my business or for investment? If the answer to that is yes, then that property qualifies under Section 1031. Now, what can I buy? It has nothing to do with what I sold. That's why I say like kind doesn't mean like kind. You can buy anything in the US that's an interest in brick and mortar or dirt or minerals that you're going to hold for business or investment or for business or investment. So the IRS says, yeah, they're like kind, but they're saying all these are like kind. All of these are definitely like kind anywhere in the United States. So I had someone sell a restaurant. They had a restaurant in Florida. They own the land and buildings, and they're retiring, and they're not paying any taxes on the real estate, on the money they're getting for the land and buildings that they ran their restaurant out of, and they're buying rental properties in Texas. So all these are like kind. So that's a big enough surprise to most people that residential investment real estate is like kind of business real estate. So if you're retiring from a business and you own your real estate, just know that you don't have to pay taxes on the real estate asset when you deed that out. You got to deed it. It doesn't work if you're selling the stock, and it never has worked on the goodwill. It used to work on the equipment. It doesn't anymore since 2017, but minerals and real estate, it still works for, and they are interchangeable. So even water rights at the bottom of the page, we have people that sell water rights under a ranch and buy another ranch, or mineral royalties or DSTs. I'm going to do a deep dive into oil and gas, since this is what we get the most pushback because people can't believe it. So of all the articles I've written, the one that I have included the most cases with by far is the one I wrote in a long time ago. I can't remember when. It was published nationwide in the Lehrmann magazine, called "Keeping Uncle Sam Out of the Oil Patch," and because people want to see the cases. So the first case, 1933, Palmer versus Bender, established the concept of an economic interest in minerals constitutes a real property right. And then in this revenue ruling, the interest of a lessee in oil and gas in place is an interest in real property for federal income tax purposes. This revenue ruling, a working interest in a producing oil lease that extends to the exhaustion of the mineral deposit. That's an important qualifier, that extends to the exhaustion of the mineral deposit, is like kind to a fee simple interest in real property. There's just case after case. Here's a revenue ruling: the acquisition of an interest in overriding oil and gas royalties with proceeds from the sale of unimproved real estate under threat of condemnation is like kind. That's under 1033, that applies to involuntary transfers. Now, what's really interesting about that is really the definition of property that qualifies under 1033 is a little narrower even than 1031's, because 1031s are good with any so-called like-kind property, whereas 1033s are limited to, it says similar use. But here's a case even under the similar use category that says unimproved real estate is like-kind to royalties. And then here's a case overriding royalty interest in oil and gas mineral rights in certain lands for an undivided 1/2 of the fee in a parcel of improved property is like-kind. And at the last sentence, you see that the definition of like-kind was not intended to draw any distinction between parcels of real property, however dissimilar they may be in location, in attributes, and in capacities for profitable use. So the courts interpret this language so broadly that an apartment complex in Los Angeles is like-kind to royalties in West Texas, for sure. Absolutely. This case after case, there's a private letter ruling, working interest and overriding royalty interest are like-kind. Now here's where we get to the no ones, the ones that don't work. A limited oil payment right is not like-kind to an overriding oil and gas royalty. So with any kind of a real property, whether it's water rights or anything else, if it's too limited, it is not like-kind. A leasehold interest in terms of a fixed percentage of all oil that might be produced is not. And carved out oil payments are not. And a production payment is not. So I blew through those fast, but that's still a lot of cases people can look up anytime they want to. And I have it in my article. Now I want to get to some big picture items when you talk about oil and gas, because it's so different than the way brick and mortar is handled. So it's best when you think of exchanges involving oil and gas to think of brick and mortar, because you do need the same attributes of a real estate sale, even though oil and gas is not exchanged, the same way or with the same kind of structure. But you always want to think of a real estate deal. When you have a real estate deal, you need a written contract of sale, and you need somebody to close it. And usually you get title insurance, and so you get a title commitment. So when we document an exchange and it's brick and mortar, we need the contract of sale, or in places like California, they call it a PSA. And then we need the title commitment, or in California and other places, it's called the prelim. And then you have a closer. It's very structured and standardized. We have a closer, and that's where we send our documents, and they make sure everything is done. And so with oil and gas, as many of you know, it's just a lot of times it's a lot more informal. So people will call me and say they're selling minerals, and I say, well, where's the contract? Well, we haven't done one, and I say, well, by law, we have to have a contract because you have to assign it to us. So you still need a contract of sale, and you don't need a title commitment, but you need something like it. So we at least need a copy of the deed into you if you're selling minerals. We just need to see how you hold title if it's what you're selling. I realize on this Zoom, it's going to be more people selling brick and mortar and perhaps buying minerals. But that's what we need. Now, the clock starts ticking with 1031s when you have a closing. So again, with real estate, that's pretty clear. So with oil and gas, you still need a transfer of title, and you need a date, of course, when the benefits and burdens pass. The buzzwords in the tax code is whenever the benefits and burdens go from the seller to the buyer on the sale, then the clock starts ticking, and I'll go over that later. A lot of y'all probably know the big picture is you have 45 days after you close your sale to identify what you want to buy, and a total of 180 to close. Now, some cautions. Even though I read you some cases where working interests qualify, they are considered like-kind to brick and mortar. There's a couple of gotchas. First of all, when you have an interest in a working interest, you have an interest in equipment. And ever since 2017, personal property exchanges aren't allowed. And also with working interest, you have such fabulous write-offs that if you go from working interest to brick and mortar, you will have some recapture. Okay, so you can have recapture and you can have some of the interest doesn't qualify, but otherwise, it does qualify. So interest in personal property no longer qualify at all. Also, reserving an overriding royalty interest in a lease disqualifies the exchange. And I realize a lot of this applies just to oil and gas in general, and maybe all of y'all are just selling brick and mortar and thinking about buying royalties, but here's just a few other things to think about in the oil patch broadly. Now to fill in a couple more things that just kind of round things out without having anything to do with minerals. For vacation homes, everything has to do with minerals. Maybe you had a vacation home you used to use all the time and you haven't been using it. So it's just sitting there and it's not doing you any good. Can you sell the vacation home and buy mineral royalties or anything else? Well, the answer is it depends. For a vacation home to qualify, then the 2 years before you close on the sale, you cannot have gone there more than 14 days each of those two 12-month periods. And if you do use it all for vacation, you have to also rent it out just 14 days or more. So there is a safe harbor for even selling a vacation home and buying mineral royalties or a DST or anything else that qualifies. And I have a word-for-word article I wrote on that too in 2008 that was published in the Texas Realtor magazine that I can send you. We already talked about DSTs. So that's, maybe y'all are all familiar with that, but that's where you buy a fractional interest in brick and mortar as opposed to with mineral royalties. It's a fractional interest in the royalties. Another topic that applies to lots of 1031s, partnership issues. So what qualifies for 1031 treatment is real broad, as I covered, but it's limited to direct interest. That's why you can't invest in a limited partnership. That's not a direct interest. That's an interest in a partnership. It's just that the DSTs are an exception. They look like partnerships, but if you set them up the way they're supposed to, those are set up, those qualify, but you can't invest in a partnership. So now any entity can do a 1031, but if anybody on this class is in a partnership and the partnership would like to sell, but the partners don't want to stay together, can you do a 1031 and invest in minerals or anything else? The answer is that's sort of gray. It's done every day, but those are called drops and swaps. You can't have your partnership sell and then you as a partner take your money and invest in another piece of property. So you have to drop it out of that partnership and put the partners in title as tenants in common. And then at least on paper, when you sell, you're selling an interest in real estate. But these are often done at the last second. So those run some risk. And I've written an article on this that I just send to you, and your lawyer or CPA has to advise you because these are fact specific. There are different ways to drop out, and anybody that does this has to be advised by their advisor on the risk of changing ownership right before you do a 1031. So those are partnerships. And just in general, when you're doing a 1031, you need to do it based on not always just how title is held on the deed records. It's how you report it for tax purposes. It's the tax owner. The tax owner needs to be the same. So that means either you are buying in the same exact name under which you're selling, or if you want to buy in a different name, it has to be set up as a disregarded entity from the one that sold. So a husband and wife in a community property state can sell individually and form an LLC where they're both the owners if they set it up right, where it's just a schedule on their tax return, that's fine. So any entity can sell, and it buys either in the same entity or another entity, a new entity it creates that is disregarded for tax purposes. Now, the way the exchange works, there's two parts of it. There's how much you spend, and then also the structure that shows it's not even an exchange. So how much you spend, you get to decide whether you want to defer all the tax or some of it. If you want to defer all the tax, you just take closing costs off the top. And then, of course, the loan is paid off. And then the rest is your equity. And that's what someone like us holds. And if you want to defer all the tax, you reinvest all of the equity and you replace your loan either with a new loan or new cash. So the property you're selling is called the relinquished property. So here they sold for 900,000. They paid off a loan of 300,000. They have cost of sale of 60 and there's 540. So what's the minimum they need to do? There's two things they need to do, just minimum. If they barely want to defer all the tax, there's two things you need to do. What you do is you take the debt plus the equity, that's 840. So you know they need to buy for 840, because again, you get to pay closing costs, which is great, makes it real smooth. That's paid just like any time, and you don't have to replace it. So they have to buy for 840 or more. And the other thing is they specifically have to reinvest their equity. No matter how much you buy, any equity you put in your pocket is taxable up to your gain. So here they went up to $1.2 million, and they more than replaced their $300,000 loan with a $660,000 loan, and they exactly reinvested their equity, so they have no boot. Boot is the word you give non-like-kind property, which is either cash in your pocket or debt that you don't replace either with new debt or new cash. Now, here's a partial exchange. Some people are under the misimpression that all they have to invest is their gain or their equity to defer all the tax. Now, for an opportunity zone, that's where you just invest your gain. 1031 is different. It's for moving everything over. So anything you don't move over, you're falling outside of the whole rationale for the rule that says we're not going to tax you if you go all from real estate to real property. So here they sold for, this is the same sale, 900,000, 300,000 debt, 60,000 closing costs, 540 equity. And then they only bought for 700,000, and they only replaced the $300,000 loan with 260. So they got out of debt for 40,000. So that's 40,000 of debt relief boot. And they put 100,000 in their pocket. So that's 140,000 of boot. So you don't want to do this if this is all you buy and your gain is 140 or less. Now, if this is all you buy, but your gain was say 340, you're still deferring tax on 200,000, which is at least 30,000 for almost everybody. And for a lot of people, it's more than that. And that's just the federal tax. But this is also a perfect place to talk about another way that people, use DSTs in oil and gas is for their remaining boot. So some people do like the farmer who just flat isn't going to farm anymore and sells the farm and puts it all into DSTs or oil and gas or a combination. But for a lot of people, it's just an extremely convenient way to utilize their boot. So if this is a piece of brick and mortar that this person wanted to buy, and they don't need this leftover money, and but that's not enough to buy the kind of brick and mortar they buy. This is perfect for either a DST or mineral royalties. So I don't know what percentages they are. If it's half the people that invest in DSTs and oil and gas, it's just boot, and if the other half, it's all. I tend to think, I guess my experience is, I don't know, it's more that maybe 60 to 80% of the time it's boot. I haven't really thought about it. Yeah, a lot of people just put the boot in, and some put it all into something totally passive. It may have some percentages. So here's how exchange doesn't mean exchange. It's not exchange. From 1921 until 1991, if you wanted to take advantage of 1031s, you had to find somebody to swap with. And in 91, they made it so easy. So I'll give you the good news, and then later I'll give you the bad news, which you can overcome just through education. The good news is in 91, they made these a billion times easier. They said, as long as you have exchange documents at the closing, which pretends this is an exchange, then we're going to let you deed to the buyer. So you get to sell to whoever makes you the best offer. So ever since 91, it hasn't had anything to do with only being able to deal with someone that's going to help you do an exchange. So you get to sell it just like anybody. And just that you have somebody like us have documents at the closing, and then you close the sale, and then you have 45 days to identify what you want to buy, and a total of 180 days to close. So that's all it is. It's not an exchange. You sell, and then we hold your money, and you identify what you want to buy within 45 days, and you close on it within 180. I think I skipped over another aspect of oil and gas that I saw people learn the hard way, and why you only want to deal with somebody that has dealt in minerals for a long time and has a good reputation in the oil patch, and who knows. It's got to be somebody who knows about this and respects this. Because years ago, I had a lot of clients that bought royalties from someone who just did not get around to doing the assignment by day 180. Your exchange fails if you don't acquire title to your replacement property by day 180. It doesn't have to be recorded by then. That's better if it is, but it has to be transferred to you. The benefits and burdens of ownership have to transfer to you before day 180. So you do have to make sure that whoever you're buying from owns what they say they own, and that you are going to get title to that by day 180. So this is the good news. Oh, another thing, the 45 days, is a challenge. And so that's another reason why DSTs and minerals royalties are gaining so much in popularity. Is not only are they passive, not only can you put exactly how much you want to put, whether it's leftover money or the whole thing, you can put to the penny how much you want to put. Another thing is they are so much easier to identify. So they can at least be a fallback. You can identify them a lot easier than finding a particular piece of real estate and negotiating a contract with a seller and either coming to agreement or not, and then doing your due diligence, doing your title work, all that stuff. Just DSTs and oil and gas are good as at least fallbacks, if not the main thing, and are easier to identify, quicker to close. Most people I know who buy DSTs or oil and gas, not only do they identify it, but then they close it right away. There's not a bunch of delays typically. So that's the good news with exchange. Yeah, you have to identify within 45 and close within 180. There's 3 rules for identifying now, but you just have to meet one of these. So really, it's either 3 property rule or 200% rule or 95% rule, but also don't spend a lot of time racking your brain with the 95% rule. It is not prudent. It is not prudent, because the 3 property rule says you can list up to 3 properties of any fair market value. If you want to list more than 3 properties, then you go with the 200% rule, which is common in the oil patch, because a lot of times you're getting royalties in several properties. So you just go to the 200% rule. And as long as the total value of everything you list of what you're buying, you don't have to take the value of all the royalties in that field. It's just how much you're buying. You add it all up, all of your choices. And if the value of all of them is within double your sales price, then you meet the 200% rule. The reason I say don't waste time on the 95% rule, it says if you don't meet either of the first two rules, you'll still have a valid exchange if you close on 95% of what you list. That's just really risky. That really requires you to close on 100 everything, because even as high as 18 out of 19 is not even 95%. So it's either the 3 property rule or the 200% rule. Now, a good QI like ourselves can set these up at the last minute, but that's not when you want to do it. But nobody can do it after you close. You cannot do a 1031 if you close your sale without 1031 documents. Now, there's split treatment. This probably doesn't apply to anybody as far as this example, but there's a reason I show this example to get to a less defined example that has the same theory. If you own a fourplex and you live in one unit and you sell it, 1/4 of the proceeds are tax-free for a married couple up to $500,000 gain. That just applies to that unit that you live in. So you'll pay tax on 3/4 of it unless you do a 1031. The reason I mention that is for farms and ranches, any of y'all that bought your house a long time ago and you either have a business with it or you have significant acreage, and even though you live there, let's say your gain is more than $500,000, well, you can treat it the way this fourplex is. Okay, so we do those a lot, and it makes 100% of difference in whether a lot of pieces of land sell or not. Someone will sell land and that they bought 40, 50 years ago, and they live on it, and they didn't pay hardly anything for it, and now it's worth a lot of money. They can sell that. And the only thing different is that it's not as well defined. You have to make a reasonable allocation of the sales price between your primary residence and the rest of it. Finally, is qualified intermediary. So this is the negative part of what they did in 91. So the good part again is in 91, they made these so much easier. You get to sell, and as long as you have a third party hold your funds, you can just buy from somebody else if you identify within 45 days and close within 180. Here's the bad part. They call those companies qualified intermediaries, and what's bad about that is there's nothing qualified about it. The definition of a qualified intermediary is everybody in the world who's not disqualified. And do they disqualify Bernie Madoff? No, they do not disqualify people who are in prison right now for embezzling. They don't disqualify people who've never read the tax code, and they don't disqualify people who don't have enough capital behind them in case one of their assistants embezzles the funds. So that's a problem. A lot of people have called themselves a qualified intermediary, and they've run off with the money. This 1031 tax group was featured in American Greed. They devoted a whole episode on that. So, they only disqualify the person's relatives or agents. All it means is someone independent. The idea is if you're not going to pay taxes, your money has to be held by someone independent. That's all a qualified intermediary is under the tax code, is anybody who's independent. And so that means you got to do due diligence. You got to find out, are they backed by a large credit-worthy entity? What kind of financial rating do they have? Do they do due diligence on the depositories where they put the money? And does the bank account require the exchanger's signature? See, there's not even a law that says the money even goes in the bank. There's not even a law that says the exchanger's name is on the account. So that's how QIs have stolen people's money. Whereas someone like us that's owned by Stewart Title, we put in writing the money goes in the bank. It's going to be your account. Our name has to be on it also, otherwise it's taxable. but it's going to require your signature for the money to be withdrawn. So our people can't write checks on it. And especially since for us to authorize the withdrawal, it takes 4 different people. And then if somehow 4 people in our company figure out how to steal the money, Stewart Title pays up on top of that. So we've done over 180,000 of these, had 0 claims for 1 penny, never lost a penny. There's just so many levels of security. So in summary, so like kind is any United States real estate that's held for business or investment that does include minerals. The cases that are in this PowerPoint and in my article discuss what minerals qualify and which ones don't. And then an exchange is a sale with exchange documents, followed by an identification within 45 days and a purchase within 180. So really note that the 45 is part of the 180. And again, I could say this a million times, make sure you have exchange documents at the closing. All that we need is some kind of a contract of sale and some evidence of title. And we need a person that's handling the closing. Oh yeah, another thing is, in the oil patch, a lot of times the so-called closer is maybe an employee of somebody that actually can work. Sometimes it's their comptroller, somebody like that, their CFO. We need somebody that has, that handles the papers and the money. And the QI under the tax code is any third party who owes the funds, but who it is to a prudent investor is somebody that knows what they're doing and is safe. And so y'all can you feel free to put this is my cell phone. Even before COVID, ever since I've been in this business, all I've used is my cell phone because I travel all over the country speaking. It doesn't make sense to use a landline. This has all been done. We do by email. Phone calls and email all over the country. Doesn't matter what state you're in, what state the property's in. And so feel free to call me. We don't charge for phone calls, just like title companies, just like real estate agents. That's pretty much how we operate, is we don't charge for time. We only get paid if you use us at closing, and it's a closing cost, and our fee comes out of the proceeds. And we only charge $1,000 for 1 sale and up to 3 purchases, because we do about 800 of these a month and we earn the interest. So it's a win-win. It only costs you $1,000. That's because we make $1,000 plus interest. Believe it or not, even though we do a lot of these and we earn the interest, we actually can't stay in business without the $1,000 a deal. But we also can't stay in business without the interest, even though it's so low. So, and this is my email address, and I'm on Instagram. And so I'm turning it back, Big Steve.
Well, thank you, Greg. There's an excellent presentation. Down in the Q&A box, we have one question from one of the participants, and it is, are most QIs familiar now with the use of this type of replacement property?
That's kind of hard for me to answer. This is the biggest surprise. I bet there are some QIs who don't know this. I guess most of them do. Well, actually, the further you get out of states that actually have production, the fewer QIs that know about this. The national QIs operate all over. So most of the big title companies own QIs just like us. So the big national ones do, and some of the smaller ones do. A lot of the smaller ones that are not in oil and gas producing states don't. It's not automatic. And especially, well, there's some QIs where this is just a side business. Now you're getting way, way away from, a strong knowledge of 1031s in a lot of cases. There are people that just try to do this on the side. So I would say way more than 50% of those aren't familiar with it.
Well, yes. Well, Greg, you have extensive experience, 27 years of being a QI and 35 years as an attorney. You'd have to say you've done thousands of these types of transactions over a career. And there's no geographical, as long as you're in the United States of America, right? You can help investors in these kind of transactions, right?
Absolutely.
Great. Yeah, I think that that's, we always like to go with experience. It's one of those episodic things. You don't do this every day. And I believe the financial advisors who work with their clients would best rely on somebody that's been through it many, many, many times. And
Mhm.
again, a quality firm like yours is essential to all this. I think due diligence is incredibly important to make sure that all the funds are kept safe and also that the transaction goes as smoothly as possible.
Mhm. Yes.
So I don't see any other questions up on the grid right now. I wanted to thank everybody for their attendance today. Greg, thank you so much for your expert testimony here today. For more information, you've got Greg's number there. You can also reach out to our firm, VENTURE.co, and speak with one of our senior directors. My colleague, Deanna Bassler, can be reached at 913-515-0740. And her email is deanna@venture.co. My name again, Steve Katcher. My phone, 814-932-7723. And that's steve@venture.co. Thanks very much for everyone participating and have a great day.
Thank you so much.